Good day, Professor Yu. Good day, classmates. This is Mayran Sonoria of Team Horcrux, presenting on behalf of my teammates Michael Abundo, Mark Apatan, and Chester Uy for our study on the financial practices of BPO companies operating in Cebu City as partial requirement for BA 280.1 Fundamentals of Financial Management, first trimester of school year 2021 to 2022. On this presentation, we will be covering an introduction of the study, the research methods used, description of survey instrument, the presentation of survey results, the discussion and personal reflections on the differences between theory and practice, and corresponding recommendations arrived by the team. This research paper aims to report the working capital management practices of some IT-BPM businesses operating in Cebu and aims to discover whether or not the theories discussed in the books are also applied in the real business environment. At the same time, we aim to learn the common working capital management practices of the firms. The study involves questions about working capital sources, cash management, receivable management, accounts payable management, and investment analysis. The methodology is through the conduction of an online questionnaire using Google Forms. A different set of questions is carefully selected per section. The questionnaire is distributed online through email. Here you can see the survey on financial management practices of Cebu companies. As for the respondent profiles, this table shows some specific information of the respondents, which includes industry, type of business organization, number of employees, sales, capital expenditures, and their asset market value. All respondents are from the IT, BPO, and business services industries. Except for one company, all others are corporations. One organization employs over 1,000 employees, and the rest have 500 employees or below. All of the respondents share the same information on their annual capital expenditures and total asset market value, which are 200 million pesos and below, and 400 million pesos and below, respectively. Moving on to the results gathered from the survey, the team found that all of the respondents do not have a specific department which decides the working capital decisions. Instead, 80% say that the working capital judgment primarily rests upon the hands of the company's owner or chief executive officer. There is one company out of the four respondents which trusts their financial controller or chief financial officer to make the call on the working capital. Another notable information from the survey is that the majority, which is 60% of the respondents, says that the personnel who decide on working capital have business related degrees. The other 20% says that some decision makers are MBA graduates. The remaining 20% of working capital decision makers, which is a surprise, do not possess a degree related to business. Reflected on the upper left is information on the working capital budget preparation, its frequency of preparation, and the respondents' view on its active management. Most of the respondents, which is 75%, regularly prepare a working capital budget. The remaining 25% do not. Out of those who prepare a working capital budget, 50% of them prepare it on a monthly basis, and another 25% prepare on a weekly basis. Although 50% of the respondents have a neutral view on its active management, 25% say that they are satisfied, and the remaining 25% are dissatisfied. The table on the right reflects each of the respondents' view on the working capital budget level of preparation and their view on its level of optimization. 50% say their working capital budget is adequately prepared. The other 25% say there is still room for improvement, and the last 25% are uncertain in its level of preparation. As for the level of the working capital budget optimization, 50% had a neutral view, 25% are satisfied, and the other 25% are dissatisfied. Working capital is crucial in every business. Its effective and efficient management is an entirely different matter. Ideally, Working capital management must be practiced by businesses regardless of their size or longevity, as it is one of the strongest indicators regarding the health of the company. It is somewhat reassuring that the survey respondents calculate some key financial ratios like net profit ratio, gross profit ratio, current ratio, and the working capital turnover ratio. Some even prepare different reports like working capital budget, schedule of changes of working capital, and statement of sources and application of funds. However, there is an outlier, Vertical Ops Incorporated, which does not prepare a working capital budget. There are a number of working capital resources that a company can utilize. Some of these include the issuance of company shares, line of credit, revolving line of credit, short term loans, long term loans, and retained earnings appropriation. Most companies that participated in the survey look for a more traditional source of fund, which is entering into a long term loan arrangement. One respondent also reported that the revenue is their primary source of working capital. Based on this information, it can be concluded that the respondents included in the study have not yet achieved a level of sophistication in their working capital resource. Two out of four respondents selected moderate or hedging or matching for the respective company's working capital management approach. One chose aggressive approach, while the other selected uncertain. The survey also shows that 3 out of 4 respondents prepare a cash budget for which one company prepares it on a weekly basis while the other two prepares it on a monthly basis. Majority of the respondents, which is at 3 out of 4, maintain a minimum cash balance requirement, while one company does not require a minimum cash balance. Cash management is necessary since there are mismatches between the timing of payments and the availability of funds. Thus, there is a need to ensure that adequate cash is available to settle expenses when they are due. Aside from this, when there is excess or idle cash, there is a need to maximize its returns. Half of the respondents have never experienced a cash shortage, while the other half had instances of cash shortages. The majority, which is at 50% of the respondents, utilize excess cash to pay for debts, while 25% declare excess cash as dividends. The remaining 25% responded that this was not applicable for their firm. A major part of the company's asset is accounts receivable. Its management is all about ensuring that customer invoices are collected in a timely manner. Good receivables management helps prevent overdue payments or non payment. 3 out of 4 firms responded that 80 to 100% of their sales are on credit. The remaining one respondent answered that their firm's percentage of sales on credit is at 20% or less. However, only 1 out of 4 respondents has a credit policy, which outlines the company's credit period, terms, discounts, and collection procedures in place. The majority, or 3 out of 4 respondents, do not. In addition, 75% of the respondents do not prepare an aging report of accounts receivable, while only 25% do so. Finally, 3 out of 4 respondents do not actively maintain the receivables turnover ratio. Only one respondent answered that their firm actively measures how quickly their company is collecting its sales that were made on credit. Payables management refers to the handling of the company's unpaid monetary obligations to third party vendors for purchases made on credit. If done properly, it can help free up working capital and develop the added liquidity to streamline processes, enhance service, reduce costs, and seize new investment opportunities. The majority, or 3 out of 4, of the responding firms have a procurement or purchasing department, while one does not. Unfortunately, all of the respondents currently do not implement a vendor selection process. However, they are all responsible and do not practice delaying payments. In addition, only 25% of the respondents said that they prepare an aging report of accounts payable, while the rest do not. Even if this is the case, 75%, of the respondents answered that their corresponding companies pay early to avail of discounts, while 25% do not. There are two main reasons why some companies maintain high cash holdings. One reason is to cover potential operating losses, and the other is to fund investments. With respect to capital budgeting, the survey shows that there are only two methods that some of the respondents are using, and these are payback period and net present value. None of the respondents have an investment in equity securities and debt instruments. As such, none of them used any of the risk analysis methods like beta, coefficient of variation, standard deviation, Sharpe ratio, and Trainer's ratio. This explains why most of the respondents' attitude towards risk is neutral, at a frequency of 3 out of 4, while the remaining one respondent is risk averse. As mentioned in the previous slides, Vertical Ops does not prepare a working capital budget. More on the discussion recommendations for the working capital and control. Vertical Ops Incorporated is a relatively young company with just over 5 years of operations in Cebu. The owners, who are US citizens, have no business related degrees. Based on their response, they put little value on the advantages of preparing and managing the firm's working capital. The occasional cash shortages experienced by the company is already a warning sign. It is recommended that the company should immediately start the preparation of their working capital budget to avoid potentially bigger problems later. The other companies, however, diligently prepare their working capital budget. In fact, one company prepares it on a weekly basis. The others prepare them monthly. However, the responses seem to suggest that employee involvement is slow regarding its preparation. The owner or chief executive officer is primarily responsible for working capital decisions. Thus, it is recommended that employee engagement be given importance. Many peer reviewed articles support that employee engagement is key to organizational success. As for the working capital financing sources, companies can utilize the following working capital resources: issuance of company shares, line of credit, revolving line of credit, short term loan, long term loan, and retained earnings appropriation. Most of the respondents look for a more traditional source of fund, which is entering into a long term loan arrangement. One respondent also reported that their avenue is their primary source of working capital. For cash management, majority of the respondents actively manage their cash position. Vertical Ops Incorporated does not prepare a cash budget. The occasional cash shortages that they encounter is a clear result of this negligence. Therefore, the team recommends first is preparation of cash budget, which can be very helpful. Thus, the companies that practice this must continue to do so, while those that do not must start preparing this report. Second, a minimum cash balance must be maintained at all times. As for the receivable management, accounts receivable turnover ratio, or ATR, is one of the financial ratios that the respondents are particularly keen on. Majority of the respondents also said that they do not prepare an aging of accounts receivable report, which is alarming given sales and credit level is at 80 to 100%. The team recommends first, companies should maintain an aging accounts receivable report, and second, an account receivable turnover ratio that is a standard in their industry must be maintained. They can refer to the publicly listed companies for this information. On the accounts payable management, most of the respondents have a separate purchasing department. However, they all have no specific policy in place for a vendor selection process. None of the respondents prepare an aging of accounts payable. Without a policy to refer to and a report for monitoring, it seems to suggest that there is no clear and effective management of accounts payable. It is recommended that the companies involved in the study should start implementing policies and procedures related to accounts payable management. Some chances, like cost reduction and investment opportunities, may be missed if they continue to disregard this aspect. Lastly, for the investment decision, the companies included in the study are either not actively looking for an investment opportunity or their current working capital is only enough to fund their current operations. The companies included in the study also, if they do consider an investment opportunity, they should use different risk analysis methods. The study revealed that there is a huge gap between theory and practice pertaining to the working capital, cash, accounts receivable, and accounts payable management in the BPO companies that participated in the survey. There are even companies that completely ignore the management of their working capital, which resulted in cash management problems like occasional cash shortages. Some of the basics are not even implemented, like the setup of accounts receivable and accounts payable policies. As such, there is no opportunity to recalibrate these policies. It is somewhat reassuring, however, that some methods are applied in practice. The accounts receivable turnover, net profit ratio, gross profit ratio, current ratio, working capital turnover ratio, payback period, and net present value are some of the examples. The general conclusion is the theories are underapplied. It is recommended that companies, at least those included in the study, take particular attention to their working capital management. There are lots of methods that are available which can help them in their working capital planning and decision making process. That's all for Team Horcrux. Thank you very much.